Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Joshua Crabb, Old Mutual Global Investors, Head of Asia Equities, to give his 3 themes for outperformance in Asian equities. Hi Joshua.
Good morning, Emma.
So what's the first theme today?
I think the first one for me, it really sits around what I'll call the sort of value that we see in the market and the inflection point. We think people are very underweight Asia, and we think that is going to be a great opportunity. We've seen a lot of investors who have been looking. Very few people have taken advantage. Because Asia has been underperforming for almost 6 years until the last year. People have really focused on independent growth companies, high quality companies, and the valuation range of these companies is now at a very, very high level. Now, when we look at sort of certain areas, whether that's industrials, financials, etc., we're seeing a great value opportunity there. So firstly, Asia, much cheaper than the US. Secondly, things are starting to improve, but not in the areas where people currently own.
So it's about being a stock picker.
Well, this is where we're seeing the dispersion starting to pick up, which is very interesting. People are going around and saying there's these events occurring, but what we've really seen, and this is a global phenomenon, is stock dispersion has been the highest level since we've seen in 2009, and we often see this around inflection points. So absolutely, this is a great time. It's not about focusing on individual sectors or countries. It's really about digging in and understanding what is going on with the companies.
And what's the second theme today?
Okay, so the second one for me at the moment is what people are starting to term the reflation theme. Now, if we look at financials, if we go back 6 months ago, everyone hated materials and oil. And today they've done quite well. And if we think about sectors that people still hate, maybe outside the US, it's still financials. Now, when we look at Asia, these are big sectors, they're very, very cheap, and they're very, very under-owned. Some of the analysis is showing people are about 3% underweight Chinese banks, for example, which is quite significant. Now, this has been caused for a number of reasons. One, we've seen loan growth decline around the world. Secondly, we've seen higher regulation and fines. And finally, we've seen the yield curve flatten out and also drop, which is bad for bank earnings. Now, when we look at that today, we think some of these are starting to change. We think the regulatory headwinds are at least slowing and potentially going into reverse if we see what is happening in the US. We are seeing that the curve is starting to steepen and that the base rate level is starting to pick up. Now, obviously in places like Asia, there are still pockets where we will see good loan growth because we haven't had that massive penetration. So this we see as a very good opportunity as well.
And what's the third and final theme?
Absolutely. So to pick one that's a bit different, India is a very popular market with many people. And we tend to have a little bit contrarian views around what we would call inflection points in markets. But we are also quite positive on India. But what we own is very different. So if we look at what most people own in India, they tend to own export companies, pharmaceuticals, IT services, etc. And that's because these have done quite well. But if we roll that back and say, what's positive about India? Why do people like it? And they like it because it has grown very, very slowly relative to what it should. And people know at some point there's going to be a catch-up. Now, part of that's been because you've had multiple parties forming government that haven't done anything for many, many years. Now with the BJP having a strong position, and even last week taking the UP election, which was a bit unexpected, has reinforced that. Now, what that's going to mean is India's going to do what China did before it, Korea, Taiwan, Japan and the US. They're going to take people that are underutilised on farms and bring them into the manufacturing sector. To do that, India needs roads and rail and power plants and all these type of issues. Most of these companies have been trading at fractions of book value. They had very little revenues coming in the door. They'd had to suffer with high interest rates and no one owned them. These are the areas that are going to really, really succeed and not the ones that people own. So India looks ostensibly as an expensive market, but these assets are still very, very cheap. The other aspect of this, which I find quite interesting, is if you look at IT and pharmaceutical companies, these are probably the ones that are the most at risk from potential trade actions out of the US, yet their high valuations and high ownership levels is quite a concern for us.
Joshua, thank you very much.
My pleasure.
This is Emma Wall for Morningstar. Thank you for watching.